Good morning, traders. Welcome to the Flow Show. Welcome to a big week for central banks and stuff going into the year end.
And not football.
No football or football.
Good morning.
Morning, mate. Morning, Kay.
Good morning, guys.
Hello.
How you doing, lads? All right?
Not bad, thank you. Not bad.
Yeah, the country's been brought to a halt as usual by a bit of snow, as is often the case. Did you get much where you were, Kay?
Sorry, mate?
Did you get much snow where you were?
Well, yeah, we were like, actually, the beach in Weymouth was white, but it's very strange. It started to snow with one big thunderstrike, and yeah, there was like a big noise, and then all of a sudden it started to snow. Very
nice.
strange.
The old thunder snow. Oh, you're lucky, mate. You're lucky.
You know that image reminds me. I used to take the district line to work, which parts of it is overground, and I still remember loads of times it being closed because of rain. And I'm like, okay, it rains in this country. At some point, you got to prepare for it. It rains quite a lot. Anyway, it would crack me up every time. Yeah.
No, it's carnage out there at the moment. Carnage, I tell you. Lots of ice.
Be careful.
Life, and we get on with things, don't we? And that's what we'll get on to now. As I said, mentioned, big week coming this week. And I'm going to talk about, after we get through the headlines and stuff, not that there's many, why it's a big week, how we should get prepared to trade it, and what happens at this time of year. Because there's lots of different cogs moving this time of year, and you need to be aware of a lot of them, how things function, how things move over that period. But we'll get through a few of the bits and pieces first. China, we got this sort of downgrade of the COVID virus that was touted last week, taking it down a level. China's top medical advisor said that the Omicron risk is now the same as flu. So, you know, a downgrade from being off the top level of infectious diseases, downgrading it to flu level. We've had the pretty much same run of easing stories out of China, you know, allowing people on transport systems and that sort of thing without test passes and that sort of stuff. So that sort of stuff is ongoing at the moment. That's all we've really had from China on the COVID front. Nothing new at all. We've had a bit of data out coming into. Oh, where am I? Lost it. Let's go. Where am I? So there we have some the data. So might as well have a quick look at last week as well while we're here. We had the US PPI data out on Friday. Softer than expected, though the core number did beat expectations. So not as soft as expected there. PPI itself confirming the drop from 8.1% to 7.4% there. Again, not as soft as expected, but still a significant drop. Now, a lot of people, again, calling peak inflation. This number has been on the slide for quite some time. It's actually been on the slide for much longer, maybe than people realise, if we look. So if you look at the number here, we were up 11.3% in July, and it's been coming down ever since. The same pretty much for the core. So a longer run of negative, or not negative, or lower numbers in the PPI data than we've been seeing in the CPI data. So if you want to look at peak inflation, it's pretty much entrenched if you look at PPI. There we can say going back even further to April, lower and lower and lower and lower and lower. So this PPI feed can lag CPI, and we've seen CPI down 4 months on the trot now. The core has just perhaps started to turn. We've got US CPI tomorrow. That's going to be a big feature ahead of the Fed on Wednesday. But just going back to some of the data going on in Asia. PPI in Japan, and there we have some high readings there. So still on the inflation front, inflationary pressures are still there in Japan, and climbing particularly on the PPI side. So beating expectations there, 9.3% year on year, up over last month's 9.1%. Coming into today as well, let's get, if I can get the right stuff up as well. Bit further data from Japan as well. Machine tool orders year on year down 7.8%. So again, we're seeing this switch between some of the sectors where the data was looking good. Now it's not looking as good. So it's not all a straight line in Japan there at the moment. Looking at some of the other headlines coming in, and say not a lot going on this morning. As mentioned with the snow picture you saw there from the UK, energy prices are being put to the test and supplies are being put to the test with a cold snap coming across Europe and the UK. UK power surged to a record on the cold snap coming over the weekend. Prices shooting higher there for day-ahead power. Germany day-ahead power was up 33%. France was up 40%. So all this stockpiling that Europe's been doing on gas and stuff over the course of the summer is already being put to the test. A lot of headlines being made of it, but of course we've probably started a month later on this cold snap than maybe as usual. We had a very, very warm November across Europe and the UK. So they should have had that as a sort of saving going into this month, but it hasn't stopped prices from ramping up higher anyway. While we're staying in Europe, obviously the ECB is coming up on Thursday, as well as the Bank of England. And on the Bank of England, there's talk that there's maybe a big split coming in the votes that we get on Thursday. Market is expecting a hike, and I'll put up the odds in a moment, but mainly expecting for the Bank of England a 50 pip hike is what's being priced at the moment. But what happens with the Bank of England is that we get vote numbers. So the 9 members of the MPC will vote for either a hike, unchanged, or a cut. And some in the UK press are seeing that perhaps the vote numbers on the size of a potential hike is going to be in question and could cause a bit of confusion in the Bank of England's message. Some analysts think that one person might look to raise by 25 pips instead of 50. Maybe 3 others will look maybe more at a 75 pip hike. So it's going to be important the vote numbers we get and who's looking at what type of hikes, because that's going to determine the path of expectations for hike sizes and a potential ceiling in hikes moving forward. If there is a bit of confusion, no doubt that's going to translate into a bit of confusion into trading the pound. So we're going to need to keep an eye on that when that happens on Thursday. But also a consideration for the Bank of England is going to be GDP, and we had some of those numbers out this morning, as well as some industrial production numbers. GDP on the whole, the monthly numbers we got for this, month on month 0.5%, so beating expectations by a touch there, reversing the minus 0.6% prior. There is a bit of a skewing there from the Queen's funeral and the mourning period that we had there, bank holidays, that sort of thing. So a bit of a bounce back on that. We also look at the 3-month rolling GDP change there, which almost like a quarterly number, if you like, and that was down 0.3%, so not as bad as expected, but still a negative. Likely that the UK will end the year in recession once we get the GDP numbers coming up. But overall, you know, we're not talking anything majorly catastrophic here in the UK as of yet. Manufacturing and industrial production out as well. Industrial production flat on the month, so missing expectations there. Manufacturing a bit better than expected, 0.7%. Year-on-year numbers not as bad as expected there. So the data looks negative, but as I say, nothing really catastrophic from that. However, UK Chancellor Hunt says the economy is likely to get worse before it gets better. So a nice cheery Christmas message from him. Now, moving on to the US, again, a lot of the headlines coming out are just talking about the Fed, obviously, on Wednesday and what's going on with rates and things like that. And there's a couple of stories out saying that this FOMC could be a bit of a clash of thinking between what the market thinks about the path of rates, how long they may stay up for, when they're going to start getting cut, versus what the Fed may tell us at the FOMC. That is going to be a big spin on what's going to happen. As we saw, we got that PPI data on Friday a bit softer. We had the Michigan survey out as well. The inflation expectations there remained unchanged on the 1 year at 3%. Was it 3%? Let me double check that. Give me a second. I can't remember if it was the 3 year or the 5 year that dipped back. Let me check.
The 5 year wasn't changed, I think.
It was the 5 year that dropped back, was it?
No,
unchanged. The 5 year made that change at 3%. That was it. And the 1 year inflation dropped to 4.6%. So a bit of easing there on inflation expectations, which again is a big part of the central bank chatter. So the market, or the news wires, whatever you want to call them, analysts are looking at potentially a bit of a confusion over what the message is from the Fed versus what the market actually sees for rates. And it's pretty much falling into what we've seen over the last few weeks. We had Powell at the last FOMC being a bit more hawkish and saying that the CD might go higher. Then we got the softer CPI reports, softer PPI reports, the Brookings appearance where he didn't really push the narrative on the hawkish side. We saw yields come off, we saw the dollar come off. So the question for the Fed this week is really going to be, is Powell going to be the same as he has been at Brookings and the last FOMC, or is he going to push against the narrative and the easing we've seen in financial conditions? You may have seen my preview about the Fed on the website. I'll put the link up shortly. But I think where we've seen financial conditions eased, that means that the market and different parts of the market are lowering rate expectations. That acts as a bit of a handbrake on what the Fed's doing. So even though the Fed can continue hiking, if the market isn't really transmitting those higher levels through to what they do, mortgage rates and that sort of thing, it has an effect of easing policy. So that's something that we'll talk about. Obviously, we get into Wednesday, but that's the bum fight to come, I think, from some in the press and analysts. Also this week, we have the good old US funding issue going on, and there's a deadline on Friday for putting a deal together to extend funding to the federal government in the US over the Christmas period into the new year. As usual, it's stuck at an impasse. The two sides are some 26 billion, I think it is, apart on negotiations there. The chances are that we get another quick stopgap funding bill put through before Friday, on Friday, just to keep the government open through to the new year. But there is a small risk that nothing happens and then we find the US government going into virtual shutdown for the end of the year and everyone could have a nice holiday off. So that's another risk to keep in mind for the coming week. Over in Russia and oil, and Russia said they may cut oil output in response to the G7 price cap, and that's according to Putin himself. He said that they're not going to be affected too much by the price cap, going to be business as usual there. And in Turkey, the backlog of oil tankers is starting to clear, so hopefully a bit of relief coming in there. Right, so before we get into the Fed stuff, you guys got any headlines you want to throw in?
No, I think you covered it again.
Yeah, I think the main event of the week will be the elections on the Fiji Islands. All the rest is just on the side, mate.
Definitely keep a close eye on those. Right, so I just want to get some early thoughts out on this week in general. Obviously, got a lot of central banks in the mix, and let's get the calendar up so you can just keep an eye on there. We've got the Fed, we've got the ECB, we've got the SNB. Next week, we've got the Bank of Japan Is it Norges this week or Riksbank this week, Kay?
Norges
Bank. So Banxico as well. So plenty of central banks going on. And what is important about this week is that you've got to look at this week and then next week and the period into Christmas, over Christmas, year end, as two separate factors regarding trading. This week is going to set us up for how the fundamentals sit and how central bank expectations sit going into next year. So whatever happens this week, that's what we almost need to take a snapshot of and use that as a basis going into next year. What happens next week and the period over Christmas is all the year end stuff. Markets can get a bit funky. Let's say the dollar's strong after the Fed, the ECB, Bank of England, whatever, but we see dollar weakness over the year end stuff. That may be a bit of a false picture. So you've got to take it as a snapshot, as I say, this week, what happens, and take next week and the rest as a bit of a lottery. Because then what happens, we get into the new year, the market will go back to trading the central banks. So it's very important you identify the difference between trading this week and trading post this week. What do you make of it this year, guys? Is it going to be a big one this week, or are we going to see new ranges, old ranges? How do you think it's going to play out, just off the bat?
That's a very good question. I think the Fed, I wrote about it, right? I wrote a blog post about it. I think the Fed, the chances are that we're going to get a slight disappointment. I know we didn't get it in the Brookings, but we have to just consider what the market's pricing, and we are pricing 50. That's going to be done for this week, and then 50 more, and then that's it. And then Fed Fund futures are pricing 2 or 3 months of flat rates, and then we're starting to cut. So do I think the market's going to unprice that, if I can use that word? Yes, I think we're probably going to, I think we're probably going to price a little bit more and for a little bit longer. Now, will that get delivered? That's a different story, but I think the market will first price it in. So I think that there's still a chance of a disappointment by Powell, and risk off, dollar spikes, yield spikes that come with that. Obviously, it's not I'm not certain it's going to happen. I just think the probabilities are skewed more in that favor, and you can also see what the yields have done. We've gone down to 3.5% in 10-year. That that's come quite quickly, quite a bit lower. From 430, what was the high. And that's basically telling us that the pivot is really close. I think it is. I think end of first quarter of 2023 is when things start to really get bad, and by that I mean unemployment is going to be rising, inflation is going to be dropping. So that's not bad. It's actually good to see inflation dropping, but for as far as the Fed's concerned, they're gonna, it's gonna be their cue to stop hiking, stop all tightening, and then consider what they're gonna do next. So, but until we get to that point, I think first is gonna be a disappointment, and that's gonna be what I hope to get as an opportunity to get into dollar shorts and trying to fade this move, because I think it's going to be short-lived.
So do you think the market's gone too far in its in its pivot? Let's call it that. The market's gone too far at the moment.
For now, yes. As I said before, what the market's currently pricing could well happen. So they do 50, and then they do another 50. Is it 25 and 25? Is it just the 50? I don't know. And then they pivot. I think that could well happen. I just think that this week we're not going to get Powell as dovish as market expects, and that's why I think that we're going to get a move the other way first. So yields are going to go higher, dollar's going to go higher, and then we're going to reverse. I just feel that the probabilities are really skewed now towards that, and everybody's now expecting, pretty much everybody's expecting rates to peak at 5%, and then the pivot coming and everything. Well, first we have to see inflation falling, and I don't think we're going to see that. Falling dramatically before the end of first quarter of 2023. So I still think we have a couple of months more of uncertainty, let's say, in that respect.
Do you think there's going to be another credibility issue for the Fed if they're forced to cut rates? Let's say 6 months into the year, when they've been telling us they're going to go up, stay up, and keep high until inflation plays ball. Because inflation pulling back to 4 or 5% is still not the Fed's target. Do you think they faced then another credibility issue if they have to reverse rates that quickly?
Yes, and Powell has actually said that. He said that they're going to err on the side of over tightening or staying high for longer. He's actually said that, and I'm sure he's thinking about the Fed's credibility and his credibility. So, if they hike, and then 3 months later are starting to cut, I mean, that looks pretty bad. So they're going to try and resist that. Having said that, if inflation drops down to 2% or 1%, which I think is not unlikely, people might listen to me and say this guy's crazy. I think we're going to get surprised by how quickly inflation is going to be dropping. So if that happens, or when that happens, I think the Fed will have no trouble going back into easing, or at least staying flat rates for a little bit. But I don't think they're going to have any problems easing if inflation tells them that this is the time to do it. And I think this will coincide with unemployment rising. So they're going to have every excuse to do it.
Let me throw another scenario at you then, mate. What happens if, let's say, inflation's 4.5%, 5% into the middle of next year, but the US is in recession, unemployment's higher, that sort of stuff. Can they cut rates on the economy when inflation is still high?
I don't think they'll do that. No, I don't think. Well, I don't think they should do that. That's a job, right? The job is to obviously they have a dual mandate, but inflation is the number one problem, and if it's at 4 or 5%, it can't really be cutting unless the world's collapsing completely.
So how do we position for that then? What would you do in that? I know it's a long way out, and it's a bit of a left field, pie in the sky scenario. But would you be buying dollars then? Would you be selling dollars, or would you be a bit neutral and seeing what the market's doing?
For the dollar, that's a tough one. I'd be selling bonds. I think short bonds is still a really, really good trade, given the risk reward. But in terms of the dollar, it's a tough one. I want to be short the dollar, but not while the Fed is still tightening. So that's a tough one. That's a really tough one.
Cool. How about UK? What's your view on it coming into this week?
I mean, I think there's going to be one thing to really closely watch, because I think the 50 is baked in, and then it's going to be important to see whether he fights back against those financial conditions, because they have an issue with QT right now, and that is that they pay more on the reverse repo then actually QT has an impact, and that's a bit of an issue. So there may be something coming out on that front. If they do, and if Powell really goes a bit strong on the quantitative tightening financial conditions, and we may see those yields start to really ramp higher again, and I think that's going to be more on the longer end. And then, as I've been saying as well already a couple of times, it's going to be a dangerous one. Or let's say there's a lot of uncertainty about what the Fed is going to do, what the central banks are going to do, and then what's going to happen into year end, because we know that traditionally people like to embellish their balance sheets or their profits, and the dollar is not necessarily in the main currency to be bought into year end. So it's going to be, I'm not sure it's going to be obvious to trade this week, very honestly speaking. And I would still, as I've been saying for some sessions now, I still think we are seeing a lot of volatility, but I doubt somewhere that we are breaking new ranges in FX. Stuff may happen, a lot more may happen again on perhaps equity front, metals, commodities. Well, you name it. I wouldn't qualify it as the real stuff, but yeah, what's going on all the rest? So I think it might not be obvious to trade it. And personally, I'm still not in the camp where the dollar is dead. I know so many people are looking to be short dollars. Yes, we had decent corrections or even in some currencies reversals, but a lot had to do with the other side of the dollar pair. But yeah, I'm put a gun to my head and looking at the whole central bank thing that's going to happen, including the Fed, ECB, Bank of Japan, and everything. I'm not sure where the dollar is going to trade, but if we see a big dip on the dollar, I'm inclined to catch a knife, to be honest, and try to buy it. I'm rather the other side. And one instrument of choice may, of course, be the dollar yen if the Bank of Japan stays pat, because Takata overnight already said that they likely won't change anything. There's been some calls, and let me find back what it is. But in Japan, the unions, one of those unions, largest industrial union, is to seek 6% salary hike, which would be, I'm not sure whether it's a first, but for sure for many years they haven't seen such hikes. So I'm not sure that they can get it straight away. Yeah, I'm still erring on the other side of the spectrum, and as I've been saying as well, I think they're going to stay. The Fed is going to stay higher for longer. So that's still my base case anyway. And as Stel said, things can change. Unemployment can take off, but we've been saying that for a few months, and for the time being, it's holding rock solid. So the last domino is still standing. Asset prices are still where they are. The financial conditions have eased, so what they have been calling for at the Fed is to get the whole yield curve into positive territory. They're miles away, so they still have room to go. So in 2 words, I think he might disappoint the pivoters this week compared to what he said at Brookings.
Yeah, I agree, and I was thinking that at Brookings it didn't happen. I still think it's a potential case for him to be a bit more hawkish, and the Fed to be a bit more hawkish this Wednesday. And I say that even at a detriment to my positioning, which is short dollars. So I want him to be a bit more hawkish. I want the dollar to rally just so I can get some better levels to short at. Conversely, for the position I'm already in, he can be as dovish as he likes, and that'll work for me as well. But as you can see on the screen there's the current rate odds going in for some of these banks going into this week. The Fed, 91% probability that they hike 50, still pricing 75 BPs as well. I'm a bit surprised at that. I thought it might switch to pricing 50s and 25s. The ECB pricing 50 as the greater probability. I still think potentially there's possibility of a 75 hike there as well, just to keep them up to speed with what's gone on at other central banks. Bank of Japan, as you can see there, adopt unchanged at 94.6% there. The BOE, 50 basis points, 70%, 75, 29.6. So leaning there towards a 50. And the S&P, they're another one I think can go, only pricing 50s and 25s. I think that's another one that can potentially go a 75, given the rhetoric we've heard from them recently. What do you make of them, Kay, and the S&P?
Yeah, I think S&P could surprise. I'm in the 24.9% cap. I think they could surprise. They told us they could do something intermeeting. They didn't. but they may surprise us, I think, and go a bigger one, because they're only doing one every quarter.
Yeah, and they're still running at 0.5% interest rate anyway, so they're still way behind everyone else.
Yeah, they're still way behind, and that could be perhaps, if we look at the five days further out, that could perhaps be the clincher for the yen to start to get weaker again. But I mean, it's a bit early to say so.
Yeah.
I think if they all, because for a change, I think ECB they're always cautious, but they might this time. Okay, they might do 50, but they might start to talk more about their QT and winding down of the asset purchase program. So there's a chance that all those central banks before the Bank of Japan could be a little more hawkish than what the market would like or expect, or just erring on the hawkish side, all of them, and then it goes back to the Bank of Japan and Kuroda and Takata as well. Takata, by the way, and that's why I was pointing at him, because when he got appointed, he's one of the two first appointees by Kishida, right? And he said when he joined, perhaps we should have a look at the whole monetary policy framework, and that had some antennas raising, and then overnight he said, no, we are not going to change anything. So that could put the Bank of Japan again, push them even further down the ladder, and really them staying on the ground level and all the rest continuing to take off. So I'm starting to think that, and I've been looking at it, although it's still like dirt expensive, those options. I'm actually looking at a little bit of topside on the dollar yen, but I'm not sure whether it's a good idea to go cash or buy an option somewhere. But it could be the surprise trade in the dollar yen, that towards the end of the year, second half of this month, these dollar yen trades back above 140. I wouldn't rule it out. Yeah, that's about it. So yeah, on the S&P, they could surprise a bit. Horatio, so that's what I mean. They could surprise and do 75.
Yeah, I think so. I think the risk is at 75 there. I think is not as great a risk, but it's still a risk for the ECB as well to go 75 as well. So yeah, we think, Horatio, that the S&P could hike higher than 50 basis points. Now, a question from our mate Charlie: does monetary policy matter as a shorter-term intraday trader, or do technicals override this? Yeah, central banks' monetary policy does matter, but you've got to look at it in two ways. The first way is which way the wind is blowing for markets, and that is a lot down to central bank expectations. So that can give you your overall bias or trend on the shorter term as well as the longer term. So let's take the Fed into consideration and dollar yen. Now, we had those highs up in the 150s. We had intervention from the Bank of Japan. That's one thing separate. But what caused the turn? What caused the turn in yields lower? What caused the turn in the dollar generally lower? The turn in dollar yen lower? That was the pivoters. That was the softer CPI. That was the market drawing down expectations for Fed hikes. That brought this short-term trend, which has really only happened since November. So, a little over a month, we've seen a big move in the dollar, and looking at dollar yen. But then what happens? We have all that. We had the CPI, we had the PPI, we had POW. Then we found a bottom, and we were off that bottom. So the market has repriced, if you want to call it that, the Fed expectations now, and it got to a level. It said, right, that's enough. That's where we finished pricing this particular passage. Now we need to run into the FOMC. What happens in the FOMC is either Powell comes out hawkish and we maybe go back to 140, or he stays the same line as he has been, or maybe turns a bit less hawkish, and we test these lows perhaps even further. So yeah, the technicals matter. right now, when we're in that little bit of an in-between period, the technicals won't matter 10 minutes before the Fed. The technicals won't matter if Powell comes out with a big headline. So that's when you switch off looking at the technicals, at least right around the close price levels. You know, you look at the wider areas, you look maybe down to 130s, 125s, your bigger levels for the techs, but your techs in the middle won't matter. But what you need to understand if you're an intraday trader trading central banks is you need to know which way the wind's blowing at any one time. The wind blowing at the moment is that dollar rallies are getting sold because the market is a less hawkish, the Fed, dovish, the Fed, whatever you want to call it. So that puts the dollar in a rally sell mode. We might get through Powell and the dollar might be a dip buying mode for that next period. You just don't know, but it's important when you do find out what the Fed's going to do, where markets are left after that, that gives you your bias moving forward. So if you're short term and the dollar's a dip buy, you know where your path of least resistance is, and you know where your risk is, where your greater risk is. And that's how you measure it each time. So that's why I said at the start, I think, and in the room this morning, I think it's more important where we're left come Friday after we've got past all these central banks, wherever price is left on Friday. That'll be important moving forward. That'll tell you whether we're dip buying, rally selling, and where we're going to go from there. And, you know, pairs like euro dollar are going to be important as well. You know, where are we going to be left after the Fed and the ECB come Friday? If it's above 106, then it's going to be a pretty bullish close of the week. If we're not above 106, that's potentially going to solidify the top that we've seen, this short-term double top up here. And it could mean we see a steeper pullback into the year end. So that's how you've got to judge these things. I think it's the price action this week, at the end of this week, where we close, where we sit is going to be important for a lot of pairs. Aussie dollar, obviously this is one of the main trades. I'm playing a bearish dollar view, US dollar view. If we can close the week holding above 68 handle, that's going to be very encouraging for me. That's potentially going to be very bullish. If we can get above 68.50s, even more so. If we can't, then again, potentially in the quiet period, the year-end period, I will perhaps expect us to pull back, maybe quite significantly, depending on, you know, what the news is. But I wouldn't be surprised to see pairs pulling back. But that's how you factor in, Charlie, the central bank line. Take which way the wind's blowing at that particular time. Use that as your risk basis for which way you want to fight the market or trade with or against the market.
Yeah, can I add something to that? Because yeah, there's this question and then there's a lot of comments I see on the chat. Look, I mean, monetary policy drives a market and drives buyers and sellers, because we can talk about technicals and price action, whatever you like. If it's the buyers and the sellers who determine the price action, not your tech levels. Tech levels come into play once the buyers and the sellers have done their stuff, or while they are doing their stuff, when they take it through a certain level that has been defined before. But let's go back to the start, if you want. It's difficult to determine, but to the start of technical analysis. What is technical analysis defining? It's defining levels of a market that has already traded. The buyers and the sellers have already traded it. So you start from buyers and sellers. So monetary policy will determine whether we see buyers or sellers of a certain asset. So yes, monetary policy matters, not even as a short term, but also on the short term, because it creates how shall I say, a concentration of interest and flows, and from there on, let me kill the score, and from there you create your levels. So monetary policy, to reply to Charlie, will always matter, whether it is for short term or even more medium term, because they will create. That will create buyers and or attract buyers and sellers, and they will then create your price action and your technical levels. And then to reply to RA, there's one thing where you are right. Techs are king. Well, I would argue that they are king, but they determine how much you could lose or how much you could win. That is a valid argument, because just because of the fact that whenever you trade, you should have a plan. You don't go into the market and say like, oh, I'm buying euro sterling because my lucky numbers are 8 and 6, and euro sterling is trading 0.86, so I'm going to buy. No, I mean, you always need to have a plan where you buy, where you think you are wrong, especially where you think you're wrong. Where if you buy and it goes up, that should be a good thing, because that means that your analysis of what's going on in the market, whether it be technical or fundamental, is right. But you also have to know where your plan could be wrong. So that's where takes could come into or will come into play. But I just wanted to add a few comments on there, because I find a lot of traders are putting, how do you call it, the carriage before the horse, and you just start from a technical picture. Everybody is free to do that. I mean, and you can do it, but this is not the way that I have learned the job for the past 40 odd years, of course, it's a different job. But if you are working in banks or as a market maker, the takes are somewhere secondary, because I was making a market and I got either hammered or by Paul Tudor Jones or whoever. But and you try to get out of a position. But those flows are what creates the market, and where and who will and which will create your technical points, because they will determine where they buy or where they sell, or for what reason they will buy and sell. So I just wanted to add this one, because it's very important to know, and that's what I'm always telling people who start to trade: just know your markets before you put the text to the market.
Yeah, I think you're spot on with that comment that something like the central banks this week, they take a lot of trading focus. There's a lot of focus put on them than there was last week or the week before. And it's the same thing when you get these events like Powell at Brookings. The trading interest comes much greater on the Fed. After this week, the trading focus isn't going to be the Fed. It's going to be year end, closing up for the holidays. That becomes a different focus. So, as Kay says, it's important to know what you're trading at any one particular time, because then you know how to assign your risk to it. And that is the important. That's why I say you've got to look at these 2 weeks in different lights, if you like. What do you make of it, Stel, this time of year and trading it? You know, you've got to separate stuff out, haven't you?
Yes, you know, this time of year, you have to remember that it actually used to be my favorite time of the year to trade when I was a market maker, because I always traded through the holidays, never took holidays this time of year, because you get all the big boys, you know, leaving the juniors to cover the desks, so you get some really nice prices, you know. They would panic and they would get a customer flow they didn't know how to hedge, and they would come to the market, and we were there to take it off them. But anyway, no, I was going to say though that this time of the year, it's the price action can get weird because of year-end flows, because of things like what I just described. So, you know, I would be careful with the trade sizing, etc. Now, the good thing with this time of the year is that if you have certain trade that you want to get into at a certain level, there's a heightened chance that you might get it, because you get some weird price action. So, you know, it can be an opportunity to get into good trades at good levels, but obviously it can also be a danger, because it can stop you out of a good trade, you know, simply because the market trades in a really weird way for a few days, stops you out, then comes back to normality. So I'll be careful. I always err on the side of caution, especially since I left the banks and started trading for myself. I'm always too cautious during this time of year.
Yeah.
So,
no,
yeah.
that's I agree with that, mate. You've got to be careful. Sab asked a question: could it be that the Fed will be able to manage a soft landing, and what will the dollar then do? Yeah, I think the soft landing thing is another sentiment, if you like, or expectation in the market that can swing around a bit. If you look at the data, you know, the PMI is all in contraction and some quite deeply, other metrics looking not so good. But then you look at some things, retail sales are still posting positive numbers. You know, even if you take out the real sales, like inflation adjusted and that, the consumer is still spending, the jobs are still stronger. So it could be that we don't see a collapse in the jobs market. And if inflation comes down and the economy doesn't go into recession, and the Fed can ease on hikes and bring hikes down to a neutral rate, and we don't see a huge amount of unemployment, that's going to be positive for the economy, and that's going to be a soft landing. What's it going to do for the dollar? It's probably going to send the dollar higher, because is the same going to happen elsewhere? Is it going to happen in the UK? Is it going to happen in Europe, where things are looking a bit more bleaker? You know, we could have a situation where the US doesn't enter recession, but Europe and the UK and others do. The natural trade is who's going to be the better currency. You're going to buy euros, you're going to buy dollars on a better economy. So yeah, the soft landing, hard landing question is something we're going to be looking and trading through the new year. It will be an important question. And at the moment, I think it's still 50-50 whether it's going to be soft or hard. I still think we haven't yet seen the full effects of all these rate hikes that can take a while to feed through. So let's see what that is. But that's definitely something you're going to be looking at into the new year. Surab, are you gents waiting for CPI tomorrow before taking any trades in any pairs, even non-dollar ones? Not especially. We're here to trade, so we'll trade any opportunities that arise irrespective of the CPI. The CPI is, for now, a risk parameter. So if you're going to be trading the dollar, you need that in the back of your mind that we've got the CPI. And so you factor that into your trading. Like Stel said, you know, maybe adjust your trade sizes. Keep that in mind. Does it mean I won't trade the dollar or anything else? Not at all. If there's a setup I want to trade, I'm going to trade it. And if I'm still holding a position over CPI, I'll either get out, manage it, decide what to do at the time, but definitely not. And I don't think that's the same for you guys either, is it? You won't, the CPI, while it may be big, it's not going to stop you trading for now, is it?
No, I echo what you said, basically.
Not me, but I am in periods like these ahead of those central banks. I do look a bit more or in depth at some crosses or so. So, and even if I'm not, how shall I say, even if I'm not trading the cross pair, especially, but I may leg in through the legs. You know, that for instance, this morning, I'm very much in doubt about the Chinese capacity to control things. We're going to see under-reporting of cases, which is already a fact. But then people stay at home just because they're sick. So I'm looking at. I bought some dollar China this morning, and I'm looking at an adequate currency perhaps to put it against if I don't want to stay in the dollar over the FOMC, for instance. So I am going to look at perhaps a little more crosses than pure dollar pairs. And actually, you were on the dollar Swiss there. It's I may actually do it and going to Swiss CNH instead of dollar CNH, just over the central banks.
That could be a nice roller coaster ride for you, mate.
Yeah, and but you know what? I think regardless of what SNB is going to do, 50 or 75, I don't see. If you look at Euro Swiss and if you look at the Euro dollar went up 10 big figures. Euro Swiss probably 60 or 70 points or so in as how shall I say comparably. So the dollar Swiss has done pretty much the same move as the euro dollar, and even with some lower rates still in Switzerland, I'm still not too much of a bear on the Swiss franc. I actually think somewhere in 2023 euro Swiss could probably hit closer to 90 than parity, but that's something for the future. But in the meantime, yeah, if you want to stay out of dollars, there's lots of crosses to trade as well. If you don't feel comfortable in having dollar yen, you can do euro yen. You can do sterling yen, although sterling yen is a bit of a strange one. And now we're still talking about central banks. I'm really confused about what Bank of England may do, and I just may be all flat in sterling because I haven't got a clue where Bailey is going to send this one. Could be trading 125 cable at the end of the week, or back at 119 for my. Yeah, really, I really don't know, because you've said it, that this could be such a spread in votes, and such a crazy, or not crazy, but yeah, crazily confusing message being sent.
Yeah.
I think Bank of England has the potential to be the most confusing central bank of the whole lot this month.
Yeah. And in that situation, you know, as a trader, you probably take that risk and you think, right, well, I might leave it alone then.
Yeah.
You know, that's
usually
too.
When I say confusing, I'm bearish a currency, but this time I really don't know.
Okay, mate. Do you want to have a quick look around at anything, any pairs?
Just looking at the time, mate. Shall we do it tomorrow? Or
yeah, that's probably a good idea.
Yeah, because there's not a lot making new ground, right? Just metals are holding up well. It's just while you're on the charts, metals are holding up okay. Last week, and I can show it back tomorrow, but I'll just let people know that I'm out of my Aussie Kiwi. People in the room know it. I tried to catch a knife there last week, but we can't even make it to the first retracement level in the 106, in the mid 106s, and I don't know whether Aussie can really strengthen versus Kiwi right here. I've rather closed positions than really open new ones. So I'm yeah. Let's do the runaround tomorrow. Sorab, I'm still you know what? I mean, I think Noki is you asking about the Noki. I think Noki is really undergoing the laws of gravity. I was expecting a bit of Noki weakness into the end of the year, and due to Norges Bank, and now it's been helped by the weakness in the oil. So I'm a bit my feeling is for a little weakened Norwegian kroner, and Euromex I'm really leaving it alone, as I was saying last week. I'll look at it once ECB Banxico is out of the way, because I've got this little feeling in the back of my mind that Banxico could be a little more dovish than what they were in the past, and even though they have very high interest rates, and in the end it's probably worth still being long MEX to a certain extent, but we may correct further before the time is ripe to get back in. So that's really it for me right now, Ryan.
Yeah, thank you very much, mate. I've just popped a link there in the chat room. This is probably one time if you're not already, you want to be part of a community, you know, to get those ideas, find out what's going on in markets, find out how to assign your risk, how to trade through this week, which is going to be a biggie. Touch wood, I hope it's going to be a biggie. So yeah, if you want to check that out, there's a link there to the ForexAnalytix platform. Come via Forex Flow, you can grab a 20% discount for that. We will leave it there for today. This week, or today and tomorrow, is going to be about setting up for the rest of the week and how to trade it. Obviously, CPI tomorrow will be a big swinger. We'll find out what happens there. Until then, have a safe Monday trading. Don't slip on any snow. And we shall see you all tomorrow. Thanks, Kay. Thanks, Del.
Cheers, guys and gals and everybody. Thank you.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.